Okay. Hi, everyone. Welcome to yet another episode of our biweekly webinar. I'm Dr. Fasanya. I'm a physician, a real asset investor, and the CEO of Dr. Breathe Easy Capital. My journey started in medicine, but along the way, I realized that financial freedom is just as critical as career success, especially for high-income professionals like us, physicians. So since 2015, I've been investing in real assets, and I started as a limited partner, even earlier than that, in residency with all the moonlighting money. And then later acquiring my first multifamily property in 2019. And over time, I got some mentorship and then started raising funds and ultimately started my own company. So today, our team manages about 184 million in assets, with over 1,500 of those in multifamily units under management. We also get involved with self-storage. We have 3 office buildings and both storage and 3 warehouses. We also deep into the luxury senior living. We have 2 of those. And then now we're moving into acquiring businesses and also investing in startups. Our mission is to help physicians and other professionals like you to achieve true financial freedom through strategic investment, specifically real asset investment. I'm going to just let George and Steve take the floor.
Thanks, Bio. Welcome back, guys, and welcome to anyone new. I'm George Ozoude. I'm an orthopedic surgeon based out of Houston, Texas. I have my own practice here in Houston, and I'm also a real asset syndicator as well. My experience and journey through investing started about 3 years when I started my first job out in practice, seeing the writing on the wall where medicine was headed, specifically for physicians and other healthcare providers. I saw it was absolutely necessary to start developing and growing passive streams of income through investments. I settled in on real assets, starting with businesses, startups, medical office, and multifamily acquisitions. I've gone on to invest in over 25 deals as a limited partner, and now as a co-general partner. I started a syndication company to educate and help other physicians and professionals on their way to financial freedom through real asset investing. And tonight, we have the pleasure of introducing and learning from a friend of mine, Steven Salvigsen. He's a highly skilled real estate executive with over 25 years of experience in valuing, managing, developing, and transacting a wide variety of commercial real estate assets. He's based in New Jersey, and he lives with his wife and 3 children. Steven takes a macro-first approach to his real estate investments, carefully selecting markets with exceptional growth prospects. He currently oversees projects in both the Northeast and the Southeast of the U.S., focusing on value-add, cash-flowing properties, including multi-tenant retail and medical office centers. As a sponsor and a managing member, he currently owns and operates 15 income-generating commercial buildings. And most recently, this past February, Steven syndicated a center in Mobile, Alabama, capitalizing on the increasing demand for healthcare-related real estate. We're real excited to have you on, Steven. That was a high-level overview. Please definitely go into more depth about your bio and your history. And then we're really interested in learning about this less commonly known medical retail mixed-use asset class. So the floor is yours, Steve.
Thanks, George. Thanks, Bio. I just wanted to say, as I've gotten to know both of you over the last year and a half, I really appreciate the education that you do on your platform and just how much your mission and vision flow through in all of the media and everything else that you guys put out. And from my first conversation with you, George, I just see that passion for freedom and the ability to practice both your medical practice and financial freedom and all of that stuff just coming out of you as you passionately present to people. And Bio, the way that you passionately talk about your family and opportunities you're opening up for them and also for your investors. They just exude out of both of you, and I really appreciate you bringing that to the investment community. What really differentiates us as SageSquare, and I think this will lead nicely into the retail medtail, is we, as George mentioned, focus very much on the macro first approach. We feel like it's very important the way we select our markets. And that's the same thought process that ends up making us choose retail or medtail or whatever the asset is within those markets. If you don't mind, I'll go through why we've chosen the current markets that we're looking at. And we are currently buying assets in secondary and tertiary cities in the US that have growing ports, disproportionately growing compared to their larger counterpart cities. We feel like this gives a distinct advantage and to grow economically in the entire market. And with all the different things that can go wrong with real estate, if you choose the right market and the right part of the cycle to have the right asset in that market, you'll be able to overcome most of the difficulties that pop up in your way. The reason we focus on ports is very simple. About 2,000 years ago, everything in this, as far as real estate, whether you were in Alexandria or if you were in Greece or Rome or wherever else, boats were transporting everything. Since that point in time, we have lots and lots of inventions and different things that have changed the way we live. Probably the most notable would be the printing press and the internet. However, in between there, you can think of all kinds of things in medicine and agriculture, all different things that we've invented. But on transportation specifically, we have rocket ships, we have airplanes, we have helicopters, we have self-driving cars, we've got electric cars, we've got all kinds of stuff. And still, most of the goods in the world travel through a port. So boats are still in vogue. And even as recently as this week, a lot of the discussion has been about the Panama Canal, BlackRock buying the Panama Canal or not being allowed to. And we see that as still a very important thing. So to break it down a little further, we say why these specific ports are we interested in. And there's lots of great cities like Houston, New York, LA, big cities like that, Shanghai, but we view these a little bit as mature markets. So as somebody who is taking capital from all over the place and deploying it somewhere else, I need to try to find returns in markets that are doing a little bit disproportionately better than mature markets. And therefore, we're focusing on tertiary cities that are on their path to becoming secondary cities and secondary cities that are on their path to becoming primary. If we drill down a little bit farther, everybody's familiar with the growth in the Southeast United States. If you want to take Charleston, South Carolina as an example, they put infrastructure in, deepening their port and expanding in around 2000. Their city has gone from 300,000 people to close to 1 million people now and has become a much larger and more mature city. We would say that they're about in the ninth inning of their cycle, getting very close to becoming a mature city. Savannah, on the other hand, they made their plans in 2002. Their growth, finally, their port and everything else, all the expansion they did to their rail transfer station, their deepening of the port, so now they could take the largest ships in the world, including the Marco Polo ship. That happened and came online in 2022. From that point on, their population growth has gone from 300 to almost 450,000 people. They started attracting some of the largest businesses in the world. And one example of that is Hyundai's electric plant just moved there. Prior to that, in 2021, they had a 3% unemployment rate, and yet Hyundai is bringing in 15,000 workers from outside the market into a market that only had 90,000 people to begin with. So you can imagine that not only brings those jobs, but all the families and all the things needed, hospitals, schools, everything else that's needed in the area. And if you visit Savannah right now, you'll see cranes everywhere in development and all of those type of things. So it's growing rapidly. And we feel like once you've done that level of analysis and examining a market, and you can see that the infrastructure is paid for, it's not faddish, it's not a vacation spot. The money's coming federally and privately to someplace, and it takes a long time to unfold, that you have a nice 10 to 15 year window where you're going to have a nice tailwind for any real estate projects you buy in a market like that. And the third market that we just bought a property in is Mobile, Alabama. They're trying to copycat Savannah. They've already done their port deepening and expansions. It's coming online later in 2025. They're also building an international airport downtown, which is also going to open in 25, 26. And they're trying, they don't have some of the tourism that those other two cities do, but from a pure manufacturing and port perspective, they're trying to do that. And just one last example to give the power of that is Savannah, Georgia was the 9th largest port in the country before they made these plans. Last year, they were number 3 behind LA and New York. They want to take over LA as number 2. They only had 300,000 people when they started this. So you can just imagine how much economic growth is pouring into a city like that to accommodate all of the different business and all the different people that need to be there. So that is how we look at markets. And I would say those certainly aren't the only markets, but those are the guide rails that keep us focused. If you focus on bigger markets, you probably find niches in those markets that maybe have the same kind of growth patterns for the same reasons. And you've probably built a philosophy around why a sector of your city is growing. So that's how we look at the world. And then within that,
Quick question. I noticed that
yeah.
you highlighted a lot of Southeast cities and states.
Yes.
Is there something to that? Are there other ports that are smaller, secondary and tertiary markets in other locations throughout the country?
Yeah, so some of that is just that we don't want to be all over the place. And a couple hundred years ago, the largest 5 ports in the country were Boston, New York, Charleston, Savannah, and New Orleans. So those cities had all kinds of different problems and reasons that other cities became more strategic, but they're realizing that they were strategic for one reason when they first were settled, that you can go way in line with a lot of the boats up rivers from those places. And that's actually why Savannah is ahead of Charleston, is you can do more once you get in. But in proximity to New Jersey, they're just on the eastern half of the country. But there's probably similar stories like that on the West Coast, I would imagine. And I would think someplace that I would look in your area would be studying Corpus Christi or studying ports like that. So, and see if there's planned economic growth coming in, getting federal dollars paired, or stuff that's already in progress, right? Because you don't want to do it when it's announced. It took 20 years for them to get it in, but you can tell when it's getting close. So we started investing about 2 years before it came online in Savannah, and bought 8 properties there since that have done very well. So
Yeah, I think that sets the table for the economic engines behind any investment, but now specifically MedTail. It's a concept that we probably have seen, we just didn't realize what it was. So we'd love to give you your high-level overview of what MedTail real estate is.
yeah, we like retail for a lot of reasons and have for a while. And then it's morphed into MedTail as that's become more popular. So I would say that there's a number of things in retail that are significantly different than your typical maybe multifamily or self-storage in the way that they're done, right? So the most obvious one is probably monthly rent versus annual rent. Or in a lot of times in retail, I have one tenant in a retail building that's been there since 1985, right? So the turnover rate is much different. The financing is usually a little different. It's very hard to get non-recourse debt on retail properties and really on multi-tenant medical properties as well. A few other things that are different and I think are very positive from the investor standpoint is that tenants typically do all their own build out. They also, in many cases, are responsible for everything. My larger national tenants, if they're credit tenants, they're responsible to repair and replace entire air conditioning systems, all of their calls for plumbing, all of that type of stuff. And their leases are also triple net. So I think I've seen you guys go through triple net before on here, but that basically means that all the landscaping, taxes, insurance, even the management fee to me sometimes if I'm the property manager, if I have a separate property manager in that deal, are reimbursable to the landlord. And so that gets reimbursed at the end of the year. Banks like that a lot. So when you're underwriting, if you have a portion or all of your center, whether it's medical or retail, that's triple net, they like that you're sharing that risk with the tenants as far as on the inflation front. And I would say a couple other things that are a little bit different is what you need to understand. And I think this very much it really comes into play on the MedTail that we're going to talk about is multifamily, we pretty much all understand. Most of us have lived in an apartment building, and same with self-storage. We've had needs for that, whether we took advantage of it or not. On retail, a lot of it is understanding the lease structures. Your value add often is done with negotiating and bringing different tenants in and slowly using those type of skills rather than putting a new coat of paint on or those type of things to add value. So you can significantly change the value of a center very quickly doing those things, but there's also different risks, right? So if I lose a large tenant, I could be 30% vacant. A multifamily, you lose one tenant, might be 1% vacant if you got 100 units, right? So, but your turnover, I could also have a center, and I think that's very much going to be the case in a center like the one that we just closed on, where most of the tenants are likely to stay for 5 or 10 years. And it's more on negotiating their renewals in an efficient way or managing other expenses like that. And that's where you drive the values. But I would say, the thing that probably attracts me the most and made me the most interested in retail is the stories of the entrepreneurs and not the national tenants that we're all familiar with, but we have I just get to meet and interview people all the time that want to be in one of my centers. And you come across people that just do extraordinary things and can figure it out. I have a tenant in a property, for example, right now who has been in the United States for 12 years, came here, went to 1 year of school, worked at a store, liked what he saw. The owner said, if you want to repeat this, you have to move at least 200 miles away from me. And he now has 7 stores that each net over $1 million a year in what he does. And he's well on his way in his mid-30s he told me he's going to try to retire at 40 with $40 to $50 million in his pocket. And when you watch this guy operate, he doesn't read books or he just gets it, right? And he just has this passion. He's very appreciative for the freedom and opportunities he has in this country, and he just works extremely hard. And I just get so energized by stories like that. And when I got my first medical property in 2020, I noticed the same thing. I noticed doctors and medical workers and physicians that really had that same mindset as in the retail, where they're very passionate about their patient. They're very passionate about what they do. They want to grow. Sometimes they're working a lot of hours, sometimes too many hours. And so they have just a lot on their mind, but they're in there doing what they love, and they're a little bit different, but a lot of times they fit in the same stuff. So the first property I had that was like this was mostly medical with a few retail tenants. And so it has more of the feel of a medical center. But what's nice about it is there's a few spaces that if you're there doing medical work or whatever, you can stop in and get coffee at a corner shop, or there's an insurance guy and Edward Jones and a few other things like that. That what I would say is like traditional medtail, maybe even places that had DaVita dialysis, but it's mostly a retail center, or Aspen Dental. Some of these players have been in this space for a while. But in the last few years, what you've noticed is a lot of medicine has tried to get more of a retail face to their larger business and do outpatient extensions of hospitals in traditional neighborhood retail centers. And what I love about that as an investor is the medical tenants tend to not leave, right? They tend to, if they get in there, they think long-term, right? They want to keep their patients there, all those things. And what my experience is, when I take over a property, if I treat them well and clearly communicate with them, they want to stay, right? They might want some improvements. They might want some different things, but they're very sticky as a tenant and client. And retail is a little bit more, certain concepts come and go, and some are very steady. So you get the extra cap rate potential that maybe retail would do, but you get this stabilizing effect that medical practices and tangential things to the medical community can bring. That's kind of the story of the property that I sent to you, George, in Alabama. And I hope to do more properties like that.
Yeah, so does it seem like the medical side is like the anchor? Like some of these big retail strip malls, they'll have a big grocery store and that's its anchor, right? Is the medical side more the anchor then? And then, like you said, the retail sides, it could be a little bit more fluid. And then my other question is, are the big hospital systems also potential tenants, or do they usually own their own real estate?
Yeah, I'll answer the second one first, if that's okay. So I have big hospital centers as tenants in most of my properties that are like this. And I feel like that's the part that's the newer development. In New Jersey here, we have Atlantic Health Systems. I see them all over the place, orthopedic places. And they have a place, obviously they're not usually doing like large surgery or that kind of stuff in there, but it's their face forward, just like retail is always done, right? Even if you're a mostly online business, you hear all this stuff about clicks to bricks and online companies that want a retail presence. And I feel like the medical community is taking advantage of that opportunity right now too, right? And so they're getting sometimes to be closer to people in their community that maybe don't have as much access to transportation. That's a little bit of the story in the Alabama property, but sometimes it's just for marketing purposes, right? So you might have very large medical buildings, but maybe they're harder to navigate for COVID flu shots or for other things like that. And you just want to get that brand and everything out in front of people. And it's also nice because you have a lot of patients there. You bring in a lot of different patients. I have this pediatric arts in one building, and they have different patients every day. The other retailers really like that, right? But there's also, if somebody's in there for an hour, whoever brought them there is shopping at the Ace Hardware. They're shopping, they might stop and get an ice cream next door. And so I feel like these concepts were probably too separated in the past, and to some degree, they still probably don't completely fit. But I think there's a place where they're merging right now. And if you drive around, whatever market you're in, it's a noticeable difference, I think, from 10 years ago, where there's just a lot more medical retail hybrid, and it's been coined medtail. It's not an official word if you're playing Scrabble, but it seems to work. So.
And guys, if you have any questions, you can feel free to leave it in the chat, or you can raise your hand and come off mute, and we'll definitely get your question out there.
So if you're going to get started, Steve, so is there like a square footage? For self-storage, we have got to be at least 100 units, 25,000 square foot. We have all this list of what are the minimum to make it worth it, because you have to pay for marketing and basement and things like that. So is there like a minimum, or like how do you view it to be $5? Somebody that's getting started and then the ideal.
Right. So I like centers that have 7 to 10 units in them, and you're usually 40,000 to 100,000 square feet. They can have more units than that, but I don't like less. I don't like big boxes that might have had a Petco or a Best Buy, because they're very hard to replace and you're very limited in who you could put back in there. And we also really like stuff that focuses on the last 2 miles between, and sometimes up to 5 miles between where the center is and where the people who that center is serving are. So it's really the part where Amazon has trouble competing with, right? So I like tenants that don't compete with Amazon, because they're not so much selling shirts and that. They're selling things that you can't really do online, like karate and Ace Hardware, ballet, pizza, anything that people like to go out to do. And then medically, obviously, stuff that needs to be done in person, right? So I like that type of stuff for those reasons, because you're not competing as much with the big online dealers. And then from a scale perspective, yes, I would say, especially if you're willing to go out of markets like we are, you need to be, you don't measure retail and stuff as much on doors and that, and kind of units the same way. But I would say buy centers at least in the $4 to $10 million range, and 7 to 10 tenants, 40,000, maybe 35,000 to 100,000 square feet, if you're going to be out of market, just to make sure that you start covering all of the cost of setting it up and all of that. So.
Good. Thank you.
Is there a specific or particular advantage versus going just all retail or all medical office park? Like, what's the compelling reason to pursue this specific type of combination?
So like I said, it's about the stability of the center. And I think for me, if I have 2 tenants, so here's part of it too, is we just put large pediatric practice in a center, right? And they want to be there. It's an extension of a hospital. They spend a lot of money fitting it out, right? Between the landlord, they split some of it, right? And the tenant. They don't want to quickly abandon that space, right? It's actually a lot nicer than what they have in their hospital space, but it's smaller in square footage, so they can justify the cost. So now they're there. They're usually signing a long-term lease, right? 5 years, 10 years, maybe 20-year lease. The longer they're willing to sign, the better deal they'll get with the landlord. Now I can be more aggressive with the rents I want to get from my retail tenants, right? And who I want to pursue, because I could take the risk knowing that I have somebody that's secured as an anchor there. And you brought up that question before, George, about are they the anchor? Yeah, and I would say yes. Usually, I had the one center we discussed earlier. I have Ace Hardware on one side and a large medical on the other side. I would say it's dual anchored, but I don't like the grocery anchored as much as some people do. And I certainly don't the JCPenney anchored stuff. I just think there's too much risk to one large tenant going out of favor and hurting your center. Another thing that's very different about retail than apartments and self-storage is for one, they're going to ask me as the sponsor of the deal, usually to personally guarantee the loan, and it's usually recourse. But the good part about that is if I have really strong tenants in there, usually the tenant is also guaranteeing the lease. So that doesn't happen on a multifamily, right? The person leaves, they owe you the rent or whatever damage they do. They don't owe you to the end of the lease, right? Or to the end of the 10-year period. They don't have to come out of pocket, right? That's usually how it works. So if I could give one example, and this kind of just shows the power of investing in retail or medical strip center like this, or a combo. Bought a center a few years ago in Savannah, and the large tenant was in there. They had 35% of the space. They controlled leases all the way till 2050, but they were only paying about $6.50 a square foot. They left suddenly about a year ago, but we knew that the tenant was strong from a financial perspective. They just strategically left. And so they had to keep paying, right? They had to keep paying their rent. In the meantime, we went out and immediately hit all the trade shows and lured a new national tenant in there that had more credibility. And when you have national tenants, the appraisers at both the banks and in the market, if you take it to market, you'll get a higher multiple, or you'll basically sell for a lower cap rate going forward. So we were able to take this mom and pop store and transition it from a $6.50 to a $12.50 rent just by signing leases, right? So that change, without doing any physical change to the property, raised the valuation of the property $1.6 million. The original equity in a deal was only $1 million. So you have this risk where you can be more vacant than a multifamily, but you also have, simply by negotiating leases and changing parties and putting together the center in a certain way, you can drastically change the valuation of a property pretty quickly. I think that's just how it just fits together very differently than you would on a multifamily or on a self-storage.
That's very neat. Yeah, because that's one of the reasons for office in general, I've been tiptoeing myself. I got few, but then apart from my medical office, I'm trying not to do more only because of what you're saying. You lose someone, it was like I won like 3. Lost someone, it took me about maybe 8 months to finally get somebody else in. But then I was only able to sign 3 years after that. So you're like, but I like your strategy though, the combination of that. I just have a question about return in general. So we always talk about aligning your goal with your investment. So for us, we are all about providing different things to different investors. So there are people that like cash flow more. Those people will go for vending machine, car washes. People that prefer doubling your money faster, they probably go for construction, where you're out in 2-3 years and you can 2x. So what is the appeal in terms of return to this, so what is the average that you're seeing for investors?
In my experience, the properties, and I love this quote that I just believe in this quote, but it's just do not buy marginal deals when you're buying real estate. And I think that's just so important, right? So I would rather have a deal that has a lot more potential return, because we all know that lots of things will happen. It's not a matter if they will happen. When you have real estate, people will leave unexpectedly. Prices might go up. You'll have some inflation you didn't expect. There's all different things, right? So you don't want to buy marginal deals. I would also say, for the reasons I just said, there's less dollars chasing retail. It's a little bit harder to get your first loan on a retail property, right? So if you don't have any real estate experience, it's not going to be easy, and you probably just can't go out and buy a retail strip center. Maybe you could partner with somebody and come in and do it, right? But it's a little bit harder to do. They want you to have some experience at the banks and that, because the cash flows aren't as even. Because of that, from my perspective, they're higher. You have some more up and down to the sequence of the cash flows, right? When somebody leaves, you might be empty, but then you might be stronger for a long time. A good operator, though, I think, as you're saying, will try to find one at the right part of the cycle and have that particular story make sense for that particular investor that you're dealing with, right? So suitability, like we always talk about. The deal we just did, for example, is I would call it an inverted add value deal. There's great tenants in there. They're all paying rent, and the return is high because you really can't do anything. You can't raise the rent much for the first 5 years, right? So there's not much you can do. They're all going to stay there. But two of the tenants are significantly below market, and they're very strong tenants. So in year 5, you're going to have a conversation with them. They're going to say, hey, I'm going to go to the market and replace you, or I'm going to have to bring you maybe step by step or quickly to the market value. At that point, you'll get a very large bump in valuation, right? So for the particular investors we just took this out to, we said, listen, you're going to get to own a piece of a shopping center that is cash flowing. It was 9+ cap from day one. We were able to put some creative financing on it and come in at 6.02 on the debt financing. So it had a very high cash return right out of the gate. And in year 5 to 7, we expect some opportunities to be able to do some negotiating and drive the back end or the valuation side that you want. The deal I talked to you about earlier, where it was a quick lift, it's just case by case. And I think you could make the analogy to multifamily too, right? You could have a multifamily that's a stabilized class B or class A, and you're going to cash flow for a while, and then maybe you rehab down the road. Or you could take over a 60% full class C and raise some extra capital to go rehab that quickly and try to drive the top line growth really quickly. And so it really just depends on how you set up any given deal and where it is in its cycle, as far as where the cash flows, when the leases are running out, that type of thing.
Can you explain your process for getting new tenants? You mentioned you're interviewing, or is that so you're directly part of that process, or what does your team look like specifically regarding finding good tenants?
Yeah, as soon as we know that somebody's leaving, there's usually terms in their lease that we can advertise it within 3 months of knowing that they're leaving. And we'll often use a broker locally or nationally to do that. When something happens more suddenly, like it did in the example that I gave, it was partners on the next plane to the next trade show. And something that I really love about retail, they do a very large convention out in Las Vegas every year with a group called ICSC, and they have stuff regionally. And it's really like a trader conference. Like, you have bankers there, Starbucks is there, all of the other major retailers, and you're actually making deals in these different rooms in the conference. So you plan sit downs ahead of time. They operate like speed dating. It's 2 days. Last year I had 40 meetings out there, and you just you schedule them before you get there, and you move around and you just try to get business done. So I really like that, and I think it's a very appropriate for that industry. So we knew we had somebody going dark. It was a kind of medium-sized space, and we just went to the conference, me and one assistant, and had meetings with every single operator that operated in that space, and set up follow-ups from there. They came out and visited the property, and we were able to sign somebody. So on a large tenant, I would say like that, it's like very focused, and we'll try to directly call. We'll also throw brokers, throw everything at it to try to move quickly. On the smaller tenants, it's more of if I have a 1,200 square foot empty space, if there's other solid tenants in there, it'll be more of, I might have 30 people looking at it, and it's us choosing who is the best fit to complement the rest of the tenants in that center, as well as who is the best. Do they have their financing set up? Do they have experience? Do they have that type of thing? So
We got a question. How do you or did you deal with unexpected mass vacancy? I think that's what we were just alluding to there. I'm asking through the lens of COVID, when many brick and mortar businesses had to suddenly close shop, leaving vacancies in many different real estate settings, from office buildings to strip malls. I presume this had a major impact on cash flows, and replacing tenants had a longer runway than it did traditionally. I think if there, you touched on it, but I guess maybe in that scenario, what did you go through specifically?
yeah, so there was, and this is, because this is a fortunate problem to have compared to most people in the space, but we were heavily expanding in that period. And one of the properties I was just talking about, I had 3 properties in 2020, and everybody was saying that retail was dead, right? Oh, we're not going to have any retail anymore. That's one of the reasons I think it's so important that both you and Bio, you both look at different assets, right? You don't just buy one asset, right? And all of these different things are cyclical, but you could tell that multifamily was getting a little overheated, maybe a little bit more than a little overheated in 2020 to 2022, right? So there's too many dollars chasing it, was driving the cap rates down, and it was very easy to get financing, that type of thing. At the same time, everybody's at home, and you turn on television and they're telling you nobody's ever going shopping again, right? You're going to get your chai latte delivered by a drone to your house, and you're going to be happy about it. And that was it, right? And so we I don't know if we thought that was really going to be what happened, but that there was just people were putting retail properties on sale. So that property that was it the first or second property I bought in Savannah? We bought 50% empty in the middle of, it was August of 2020. It took 38 banks before I got one to underwrite it. Now, this is something I didn't mention earlier that is a little different about retail too. When you're coming through and you're looking at whatever places that you go to just look for retail, for commercial deals, whether it's Crexi or CoStar or local brokers, usually you see stuff, they quote a cap rate on a property, right? And most of the big operators in retail, they quote the cap rate on the current occupancy. So it might say a 7 cap on the 70% occupancy. So a deal like that, what you need to do is a simple calculation is you just say, how much, what is this property worth if I simply filled it up, right? And so if you had a property that was 70% full and it was a $5 million property at a 7 cap, right? That's $350,000 in net operating income. If you filled that property up, you'd be at 500,000, making it worth 7.1, which means that just by filling that up, you've made well more than 100% on your equity. So there's opportunities to look for. And so in that 2020 period, that's how we were looking at it. We bought something that was a 10 cap on 50% occupancy. And so we knew if we could close it and roll up our sleeves, the location was great, the market was great, but we were dealing with COVID. We didn't know how long that was going to take. So we made sure that we had enough cash. And that's definitely something I would say, right? Like, I think in retail, you want to make sure that you have enough access to do it. You don't want to ever play scared. To me, you'll do really well if you can play from strength and not be afraid of losing tenants. If you constantly just keep an eye on who all your tenants are, where they're at in the cycle, and you know exactly what your plan is if they were to leave, what you're going to do, right? Who you're going to pursue. You can even be having those conversations ahead of time. Somebody, hey, if I ever left here, if you ever had space in that building, would you come over here? A lot of the tenants will also, especially medical, look to expand. Sometimes they tell you ahead of time, if something else opens up, I want 2 more suites. But we filled that property up, and then it was completely full in 2022 with mom and pop stores. Right. So then we did a cash out refi, took our initial equity back out. And then our second phase of our plan was to migrate it over to national credit tenants so we can get a higher exit cap and refinance cap. So that's what we're in the process of doing now. We're 50% national credit tenants and 50% mom and pop. And that's just important because the banks will give you a higher valuation, and even buyers will give you a higher valuation if you have half of the stores being Panera and Starbucks and those type of tenants versus local ones. So I really am passionate about the small tenant, but I also really do appreciate having the center anchored by people who are, stronger financial suiting or maybe more recognizable, and that, whether it be medical or national retailers.
Are you still generally seeing 10 cap? I think your Mobile deal was like around a 9 cap, right?
Yeah, that was a 9.5 cap. No, it's not typical, but you could find it. Just you have to just keep looking and finding stuff. And that's if something's trading at a cap like that in this environment that we're in, there's something wrong with it. And I don't think that's bad, right? So I think what you guys look for and what I look for is we look for solvable problems. So I want to see the stuff. I want to put in front of me anything with a problem. And that one, they had some big tenants leave right because of COVID, the one in Savannah, right? You had a problem to solve. Okay, will I be going in there? Will I have enough capital to get through however long this takes and fill it back up? As long as I'm able to do that, it's pretty clear that I'll have a much more valuable asset. And I think that the deal that you're referencing in Mobile, which that's a closed out deal, so I can discuss it, it was more of the leases and all of that. Some of them were rolling off shortly. Some of them were not. There were certain inefficiencies in the market and in the center, the way that it had been run, that created an opportunity that we saw. And we were able to get it for that price. And this is something too, as you guys syndicate, I don't know if you've done one of your presentations on this, that I don't think syndicators in particular tout enough or bring. If you have folks that are interested in LP investing, is the fact that it's usually the GPs in this scenario that are signing on the debt. I just think that gets under presented, because especially on retail, it's not non-recourse, it's recourse debt. And recourse debt means that if we lose the entire center and the bank is still not made whole, that means I'm coming out of pocket, and whoever's GPing me is coming out of pocket, right? So you can, if you have enough equity in a deal, you can get around that. You can get carve outs around it. But if somebody's asking me, I'm raising money for a deal, and they're saying, hey, why are these splits? Why is this? Why is that? You bring that up and you say, hey, wait a minute. Do you want to come on and sign with a debt with me? What does that mean? You're severally and completely signing on a debt. That means that each of us are signing on a couple $1 million worth of debt. Do you want to do that? Is that worth it if you want another piece of the pie in there? And most people say no. So I think that's a service that sponsors bring to their LPs, and make it so you can run your rest of your career or the rest of the things that you want to do and not think about that aspect. The other part of that, and you referenced that Mobile deal, is if you've done more deals, you start to get offered different kinds of debt, right? So we did something called a swap with a cap tail on this, and we were able to get the seller's swap transferred to us. It was in the money, and that was able to buy down the rate from 7.25 to 6.05 for 3 years, or 6.02. And then we were able to raise a little bit extra money to buy something called a cap tail on the back of that. So the highest the rate can go in year 4 and 5 is 6.2%. We did that because we actually think rates will be lower in that period. And so that's just the most we can pay. We believe we'll be paying lower than that, but we wanted to make sure we had enough debt to at least let our business plan play out, enough term on the debt. Just in my experience, when I was doing deals earlier, those type of things didn't get offered to me. And so if I was trying to underwrite this deal at an 8% cap rate, and I could pencil the numbers at maybe 7.25 on my commercial debt, it would be very hard to make that work. That's just, I think, something that you should be looking to for your GP. LP should ask a lot more questions to their GPs about what debt they're getting, and is it better than the market? Is it even with the market? Is it something I could get on my own? And I think that GPs should just tout that more, because I think it's a big deal. It's a big thing you're taking on your shoulders.
Oh, I totally agree. It's one of the first things I look at in any deal now is, what does the capital stack and the debt structure look like? And I think it's a great point you make, because physicians can have high enough net worth to contribute to some of these deals as key principals. I know Bio has done that. And that's something to be aware of. You can be an LP or you can be a key principal or both. There's, like anything, there's risks and benefits to any of these ways that you can invest. And KPing is something I'm looking to do in the future. And I know a lot of other physicians that do it, but you have to be aware of some of the risks that come with being a guarantor on the loan.
Yes, absolutely.
Yep. Yeah, I'm just going to add a little bit to that in terms of one, getting more opportunity over time, right? So, and also I wanted to ask a question about the type of loan. So right now, because of the interest rate environment, so same thing, after 1,000 units, you start getting ability to get these agency loans, right? So now the current one we get like 5.4 actually, currently in the current deal. We're also able to do assumable loan. If it's like 3.5, 4%, they still have 10 years left on it. So in the commercial space, I don't see it. I don't think I've seen loan assumption. Is there a loan assumption deal in retail?
Yes, there are. That's essentially what we did here. There wasn't that much term left. So when I said that we acquired the person's in the money swap, that's what we did. We could have continued with their loan if we wanted to, but it was for a smaller percentage of the deal that we wanted. With a swap, we could take the benefit that was left from theirs and apply it to the cost of us buying down our loan. So I think that's a great point you make as well, Bio. So retail trades at higher caps in general, always has, right? They're converged a little bit now because multifamily has been having a little bit of trouble. When everything's at equilibrium, I would say 100 to 200 basis points higher for retail than multifamily. But the debt on multifamily is less too, right? So usually you will see multifamily, and that's because there's government agencies involved in putting out products that are subsidized and sometimes a little bit cheaper, where you're a commercial loan that you're buying on retail or medical buildings or that type of stuff is simply market based, usually based off the 10-year loan for most products. There's just another difference between the two. I don't think it's good or bad, but we look at like the spread, right? So I'm sure you do the same thing. And I don't like to buy anything where like day one, I don't have a 200 basis point spread between my debt rate and my cap rate that I'm going in at. If it's full, I change that a little. If I'm buying something that's 50% empty, I have to say, okay, listen, I'm getting a discount. Some of this is going to come to fruition as soon as I start filling it back up. But that's more of a distressed, non-normal situation.
Yeah, you're looking at break-even occupancy like 70%-ish, most of the multifamily. So obviously, if you're not, you need to have a little bit more on top, right? Delta. What about reserve? When you raise money, so I know you keep saying you have to have a lot more money. So you feel you raise more money in
So I did raise
versus
more reserve.
multifamily.
Right. It depends. I raise more reserve. Again, it's going to depend a lot on the property. I have a property that's straight 20 unit medical unit. They're all between 1,000 and 3,000 square feet. The tenants never change. To me, it functions a lot more like a multifamily. Like it's actually that's probably my favorite property. They're all single story, like condos, right, in the same unit. But the tenants all pay on time. No one's ever missed a payment. It stayed 100% full since the day I bought it. I bought that property though because the market rates there, the former owner he had left everybody on a month to month. And the broker told me, I'd show this to you, but you're not going to be able to finance it because the guy set it up this way and the commercial lenders aren't going to know what to do with it. So then that just became finding the right lender who could understand that. And it's because the guy managed 10,000 multifamily units. So he set up his medical practice. Everybody was like a month-to-month residential. So there was just this displacement. And there were leases in there that should have been $20 a square foot a year that people were paying $6 because he just never said anything. All those tenants have come up to market now and nobody's left. I let them gradually get up there, but I had to sit down and have coffee with the different tenants and say, hey, look, I want you to stay, but this is the market and everything else. I'm going to show you a path that you can get there. But as a fiduciary for people investing in this real estate, we need to be at the market levels at some point. And so that one, I don't need a lot of reserves, right? Because it's predictable. But if it's a center where, you have a little bit more shaky, you got to set more money aside. And this deal here, we have some that the bank was requiring that just stays in a reserve account. Another thing that happens though is you get access to everybody's security deposit too. Sometimes they collect large security deposits. Unlike multifamily, where you have to keep that in a separate interest-bearing account, it's basically just set up as a contract. You just got to pay that person back if they were to leave at the end of a term. So if somebody's got a security deposit and they have a 10-year term, you basically have capital of theirs that you're using. So that's allowed us not to overraise the backup reserves, because you can keep that part to keep the bank happy. They'll allow you to use those reserves for that, those deposits for that. And I wouldn't say it's excessive. And you think of it this way, if you're doing a lot of rehab in multifamily, you might do some extra raise for those costs. In this case, where the tenants are often doing a lot of the rehab, I'm not really raising for that. So it's just different. I wouldn't say it's better or worse, but yeah, you do have to think of it specific to that asset.
Thank you. Also, one more question. In terms of hold time, I'm getting it that it looks like your hold time for your investment is close to 10 years. Or is it how long? For like multifamily, we tend to do, we say 3 to 5 years, but really it's 5 years. But for retail, is it like forever, 10 years? What are your usual hold?
Yeah, so I maybe I should have mentioned this in the beginning, but I've done a lot of deals in, I think, legitimate partnerships, I would call them, right? So 2 to 5 people. That's what I was doing for a long time before I started to syndicate, where they all have an active role. They're usually everybody signing on debt in some way participating, right? So just a traditional joint venture partnership like that. In those cases, the people I've been partners with have typically preferred doing like the Burr method, where we're trying to drive value by rehab, refines, repeat, and just keep doing that, right? So you take the initial equity out and you buy a next property. And that's how we've expanded those partnerships. In syndication, right, where we might have a lot more investors and we got to put more of a specific time period and goal down. But I do still prefer, if the particular investors in that deal are open to it, doing kind of the infinite return model, if you're familiar with Kenny McElroy's term there, where we get everybody's initial equity back and then the splits change. And that way you got your own money back. You can put in another deal, but now you've got this residual income. And if it's a really good properties that are good are hard to find sometimes. And it's, I think, nice to keep them sometimes if people have a growth and income perspective. That's preferable. This one that we're doing here, we put a 5 to 7 year hold down because 2 of the big leases had an opportunity to renegotiate after year 5. So I don't want to put year 3 to 5 because we won't be able to take advantage of those large jumps. So this one was much more suitable for people who want a nice, probably payable out 8 to 9% return the first couple of years, right? We did an 8% pref. It's not a guarantee. It's just a sequence of events, but it's actually throwing off cash day one. So we think there's a high chance that we'll be able to pay out some significant cash for 4 or 5 years and then have an opportunity to drive the value. And the way it's structured and it's aligned is, right, if you have a deal structure like that, an 8% pref and then a split on the back end, if everybody gets 8% for 5 years and we sell the building and that's it, then basically the sponsors barely get paid. So there's high incentive to drive the returns much higher than that, because that's where a higher portion goes to the GP. And so I think if your downside is, yeah, of course the deal could go bad, but in general, you're aiming for an 8% and you'd be like, I'm okay with that, but there's an opportunity for me to make a lot more. If that happens, then the sponsor's going to make a lot more too. I think that has been pretty palatable format to put in front of people.
Awesome. We are at the hour. That was really great information, Steve. If anyone has any other questions, please, you can come off mute at this point. Steve, you're definitely a wealth of knowledge. Where can folks reach out to you if they have more questions or more interest?
Yeah, so sagesquarecapital.com is my website. You can reach me on there. You can get on my list. You can join me on Calendly. You can reach out to my admin through there. You can do any of those things, or you can join me on LinkedIn. Happy to join anybody on LinkedIn, and you can communicate me with there as well. Find my website and stuff as well through there. Yeah.
Perfect. Awesome. I want to thank you again. I think this was just a really great webinar. I'm going to be going back and taking more notes. I'm going to be hitting you up as well just to talk shop. Thank you guys. Any sign off from your side?
No, just want to say thank you, Steve. Thanks everyone and for coming. And yeah, this is why we do this, you know.
If I could say one last thing, guys,
Yep.
I would just say to anybody listening, if you're not in the real estate game right now, today is the first day of the rest of your life, right? So passive investing is the path to freedom. And you got two guys here in George and Bio who are doing mentorships. They're putting on these webinars. They're doing education. They're raising capital. They're showing you what to do. Instead of waiting 10 years and saying, but 5-10 years from now, I might go out and flip a house, and then I might do this, and then I might do that. Find some way to get in the game this year. You won't regret it. That is, to me, it's been a great path, and it's a great path for freedom, passive income. And I just thank you all for being a part of this.
Thank you,
Thanks,
Steve.
Steve. Yep.
All right, guys,
Join
that
Steve,
is it.
find us on LinkedIn. Find Steve, find us. Okay. Take care, everyone.
Thank you.
Thank you, guys.
Bye.